for everybody. So we have Patrick. Patrick, I don't even know how do you say your last name?
It's Nibe.
Nibe. Okay, so silent K. Okay.
You got it. Yep.
So Patrick is with Commerce Bank, and I think Patrick, are you in Tucson?
No, actually, I'm in Scottsdale. I'm off right across the office from
Okay,
Germany.
cool, great. And so Patrick has been generous to walk us through the lovely Mainstreet program that's floating out there, and so which I'll let him dive into some of the particulars. But Patrick, if we maybe start off with what is the Mainstreet program, and then we can start diving into the details of how does somebody get approved through it, and et cetera,
Sure.
et cetera. Thanks for taking the time.
Yeah, no problem. So, we've been participating in this program for several months now, and we have a number of loans that are in the pipeline. I think we have probably 4 that are good candidates, but won't know until we finish the underwriting on that. But I just, to give you guys an idea of the success rate, if you will, we probably fielded over 100 requests for Mainstreet loans, maybe more than that, and obviously only about 4 have gotten to the point where we're in the midst of underwriting. So with that being said, for those that don't know much about the Mainstreet program on a very basic level, it's another program that was established by the government to try to help medium and small businesses to get access to capital, working capital, and mainly because of what's going on with the pandemic. So these businesses had to be, trying to think of the way to phrase it. They had to be essentially profitable and operating normally prior to the onset of the pandemic. And essentially they have to have, even if they weren't profitable, they have to at least have positive EBITDA as of the end of 2019 year end.
Okay.
So we've turned down a number of businesses that did not meet that threshold. So they were clearly having issues prior to the pandemic.
That's interesting.
Yeah. So
now is that, Patrick, is that profitable for a full fiscal year 2019 per the tax return?
Yeah, I mean, at this point, you probably should have filed your tax return 3 or 4 months ago. You might have gotten away with an extension still, but I mean, at this point, barring some really exceptional circumstance, like maybe being audited by the IRS or something like that, you should have your tax return in. And, everyone at this point that we've asked for a 2019 tax return has provided one. So, the long answer, sorry, to that is yes, you should have a 2019 tax return. But we were accepting financial statements several months ago for businesses that said, we're still on extension, should be finished August, September, October timeframe. So I just collected a couple more tax returns today that have been on extension. So
what makes the Mainstreet program different than PPP and the disaster relief loans? What's different about the Mainstreet?
Yeah, great question. So one of the things that people ask right away is that the PPP was forgivable, so those were loans that people weren't going to have to repay. But the Mainstreet loan absolutely has to be repaid. There's no planned forgiveness. There's no way out of paying back that money. So if you borrow it, you're going to repay it.
Okay.
The other thing that sort of sets this program apart from conventional lending, especially, but even the SBA lending, is that this program is essentially being backstopped by the Federal Reserve Bank, whereas the SBA is sort of its own entity. The Federal Reserve Bank is its own entity, and it's the one that's behind this. So the Federal Reserve Bank is setting up, and specifically the Federal Reserve Bank of Boston, not that it matters probably, but it's setting up a special purpose vehicle that's going to purchase 95% interests in all the loans that are established under this program.
Huh.
So, the interesting part about that is, like, for example, there's 2 ways that banks or lending institutions that are participating in this can partake in the program. One is you can fund the loan yourself and then sell it to the Fed at a later date,
Okay.
or you can pursue the loan as a simultaneous funding, which is how our bank is doing it, where essentially the approval of the loan is subject to the Federal Reserve saying, yes, we will buy 95%, and we won't fund until the same day that the Federal Reserve funds. So that way we never actually our bank never takes 100% of the risk onto our balance sheet. So 95% guarantee is a pretty big deal when, in the SBA world, the most you're going to typically see is 85, maybe 90% on a couple of their niche programs. But for the most part, 75% guaranteed from SBA.
So what are the loan size ranges from?
Right. So you got, on the smaller end of the spectrum, the Mainstreet new loan program, it goes from 250,000 up to 35 million.
Okay.
And then you got the Mainstreet Priority Program, which goes from it's either 5 or 10 million all the way up to 50 million. Okay. And then you've got the upsized tranche program, which is something like an additional 10 to 300 million. The upsized tranche is only for businesses that have already received one Mainstreet loan and are now applying for another one. So that's a very limited, to be honest. I mean, there's enough companies having a hard time just getting through the program. I don't think there's going to be too many that apply for that program. But the new loan and the priority loan program are the two that you'll see. So those have a $35 and a $50 million limit. On those two.
And then what are the terms and conditions for paying it back?
Sure. Yeah. At a high level, it's a 5-year loan. What makes this? Well, let me get ahead of myself. It's a 5-year loan. Your rates are going to be based on either the 30-day or the 90-day LIBOR plus 300 basis points. Okay. So it's really low interest. You're looking at the low threes these days. There are fees. So essentially what a borrower is looking at paying most likely, and this can vary by bank, but the maximums that are allowed to be charged, which we believe is probably what most banks are going to charge, is 2 points, because 1 point goes to the Fed. Essentially the Fed is charging the participating bank a point. And the bank is allowed to charge the customer for that point that they're being charged by the Federal Reserve, so that it's essentially a pass-through. And then the participating bank is also allowed to charge up to an additional point for its own fee and expenses. So we're just telling people straight up, if you do a Mainstreet loan through us, you're going to be charged 2 points. Okay. That's something that they like to usually know right up front. But again, when you look at the interest rate, and then also one of the very interesting parts of this program that make it extremely attractive to businesses, particularly businesses that are really struggling, is that the first year of the loan, there are no payments due of any kind. Okay. Interest is accruing, but there's no payments due. The second year, all that's due is interest payments. And then the third, fourth, and fifth years are curtailments at 15%, 15%, and the remaining 70% for the last year. Now, something that's worth noting about this program that's extremely advantageous to the borrowers, in addition to just, not having any payments in the first year, the banks are allowed to give the flexibility to do annual curtailments. So that means that if a business gets a Mainstreet loan, they may not make a payment for up to 24 months.
Wow. That's crazy.
And then even that payment would only be interest accrued in the second year, and they wouldn't make any principal and interest payments possibly until the end of the third year. Now, it would be a lump sum, but again, the whole purpose of the program is to provide relief and working capital to businesses that are struggling. So to be able to get that money and either one, just obtain working capital, or two, be able to refinance existing debt and be able to get rid of that current debt service immediately, and then not have to make any debt service payments for at least 2 years, is pretty amazing.
Yeah, that's impressive. And how does somebody qualify?
So again, you have to have been, um, whether you want to call it profitable or at least have, positive EBITDA for 2019. That's sort of the first criteria. The
Okay.
second criteria is that you have to, well, and of course there's sort of standard business eligibility things, like there's a drop dead date that your business has to have been in existence. And, if you don't have 2019 year-end financials, then there's nothing to base your loan amount on. So that's kind of a no-brainer there. If they establish their business in 2020 and you don't have any 2019 financial information,
Just not
you have
going.
you have no qualifying criteria. But aside from that, all the normal SBA business eligibility criteria applies. So if you go pull the SBA SOP that lists all the ineligible businesses, gambling, passive income, speculative, all this sort of stuff. Those, if you were eligible for a PPP loan, then you're probably going to be eligible for a Main Street loan. But if you weren't, then you're not. So.
And so when you say that you're profitable in that prior year, obviously you're probably not during the COVID. My guess is, is it a debt service coverage ratio that you're looking for in the interim? No?
No, but that's great. That's a great point, Dave. So there's some businesses, as you guys probably well know, that have actually done better during the pandemic, like Amazon, for example, or Walmart, or any, various industries, personal protective equipment. They've boomed since this happened.
Yeah.
One of the criteria to qualify for a Main Street loan is you have to demonstrate financial detriment. So you have to be able to demonstrate that you suffered. Now, it doesn't mean that you can't still be having a good year, right? Like, I have a guy that we're working with that he owns an RV park up north.
Okay.
Very touristy. 70% of his revenue pre-COVID was international. So you can imagine what happened to him when COVID hit. But a unique thing that's happened is that people domestically have been becoming stir crazy and looking for things to do that can be socially distancing and get them out of the house and still maybe take a vacation, whatever. So he essentially has a business that can offer people that. RVing is going crazy right now.
No.
So he's actually recovered amazingly, and is actually pretty much back to where he would have been as far as monthly revenue figures. Now, he's still going to show a deficit for the year, but his business is doing very well, and looking into the foreseeable future, there's no end in sight for his relative continued success. So I say that because he's going to be able to show a detriment for the year, which is all you have to do. But today, his business is not struggling. So there's nuance here to, obviously a business that's been struggling since the pandemic hit and is still struggling today, clearly a candidate. But just because you struggled at some point, if your business has taken off and you're starting to do very, very well, that does not disqualify you, because you did suffer. And as long as you can demonstrate that, you'll be fine. But, I had a few businesses approach me for this program that when I asked them, were you negatively affected by the pandemic? They're like, no, we're having a record year. I said, well, unfortunately, you're not eligible for the program.
It defeats the purpose. So out of the 4 from the 100 that you looked at, what was the distinguishing factor for those 4 that made it so that you went, thumbs up?
Right. So a wide variety, right? Like we've already touched on some of them. Some people approach me, they had negative EBITDA or whatever for 2019, not eligible. Some are having a record year, not eligible.
Yep.
Some, I'm trying to think outside of, thinking about the Main Street, criteria itself. Because there's only really a few things for the Main Street criteria. But see, the Fed, in partnering with banks, and this is buried within all of the guidance for the program, encourages all banks that sign up as eligible participating lenders to adhere to their normal underwriting criteria. Okay. So this is extremely important to know, because one bank to the next bank is probably going to approach and implement this program differently. So for example, Commerce is a small community bank. We have 4 branches in the state. We're very conservative. And we decided, before we even registered for this program, that if we were going to do it, we were only going to do secured Main Street loans. The program allows for unsecured loans,
Okay.
but we said, no way. So we've had a lot of businesses, Dave, that when they approached us, they were either like software as a service or some other service related, business, and they had no collateral. And so without collateral security, they may qualify for the program at the Main Street level, but they don't qualify for the program at our underwriting level. And so we, had to turn them down and, make recommendations for them to, maybe reach out to some of the larger national banks. Bank of America is participating. See if some of those larger banks that, are potentially capitalized to take larger risks might be willing to, suffer a 5% only loss, on a loan that our bank's just not prepared to take, that kind of loss. So
That's good. So if you do with this with collateral, is it 1-to-1? Do you have to be at a certain level, or how much?
Great question. Yeah, great question. So that's going to depend, right? Obviously, the best collateral that we could probably take would be commercial real estate.
Okay.
Again, that's going to depend, right? You have a retail sales commercial real estate. Like if you have a mall, you're probably not going to get a very good advance rate right now. But if you have, let's say medical office, then more than, again, as long as it's not elective stuff, right? If it's more like, critical care type stuff, then you're probably going to get a very high advance rate against that. So it depends on the collateral. Commercial real estate being probably the best collateral that you can bring to the table, followed by equipment, followed by inventory. And then of course, there's always, with this program, it wouldn't make a lot of sense to have cash collateral. We've actually had 1 or 2 people approach us with the idea to do cash collateral. And there's been some further explanation from the Fed on that. Because at first we had a deal with a hotel. It was a hotel here in Phoenix. And as you can imagine, that industry's been crushed.
Yeah.
But this hotel was actually in very good financial shape before the pandemic hit. So they're sitting on a reasonable amount of cash. And they were just being very forward thinking about the future because let's face it, they probably are facing a protracted downturn here. And I just read an article this morning from the Phoenix Business Journal that, basically says aviation and hospitality is probably going to be down for 4 years. So they were being very forward thinking and saying, we want to get out in front of this. Clearly we qualify, which they did. But at the end of the day, the problem with that particular opportunity was they have a lot of debt. So while they were in good financial shape from the standpoint of assets and liabilities balancing out, there wasn't a huge negative equity position or anything like that. They have existing debt with a a commercial mortgage-backed security lender, CMBS or whatever. And while the terms were good at the time when they took the debt a couple of years ago, it's extremely difficult to work with mortgage-backed security lenders. Yeah. And there were prohibitive things in their existing debt that essentially we just ended up not being able to, help them because they had too prohibitive of, restrictions in their current lending. So it didn't work out for reasons related more to their situation than it was us not being willing to do the loan. But the reason I tell that story is because they were willing to pledge cash, a huge sum of cash for the loan, because they were then going to get all this working capital back. And, knowing that they would be able to cash flow it because of going 2 years without having to make a payment, it was an attractive offer for them. It was an attractive offer for us. But again, this was prior to the Fed releasing further guidance on that. And so the Fed has basically said, you can do cash pledge collateral, but there's a limit. I want to say it's like 30% of the outstanding amount, which we would have exceeded that. So good to know now, but the deal didn't work out anyway. So, but yeah, that was a long-winded way, Dave, of saying that, sure, you can do some cash, collateral or something, along the lines of marketable securities or whatever like that. But other than that, which would probably be rare since people need working capital right now, commercial real estate, followed by equipment, followed by inventory probably.
That's great. And so just for clarity purposes, the 5-year, is it a 5-year term and a 5-year amortization? So
That's a great question. Yeah, so the amortization is really screwed up. I don't know how you would describe it, to be honest with you, because, and the way that I've described it to people is, don't try to think of it as an amortization. Just think of it more as a year-by-year sort of, case. It's a year-by-year case of how you're going to make repayments. So the first year, no payments, interest is accruing. Second year, no payments. And again, the way that we're approaching this is that if we're going to probably qualify any borrower, they're going to qualify for annual curtailments, which would be the maximum benefit for them. So end of year 2, you're just going to pay the interest accrued during year 2. And again, the way we've had to do this with the people that we're getting down the road with is take a dollar amount and crunch it out year by year and kind of give them, again, because we can't really give them an amortization. We're just saying, well, okay, in year 2, based on if you started with this amount, you accrued interest in the first year and didn't make any payments, that means at the end of year 1, your balance would be X. So then we're going to base your interest in year 2 off of that starting principal balance. And again, we're making assumptions about LIBOR, right? Like if it was today, your rate would be this, and if it stayed the same, which by the way, depending on which LIBOR you use, depends on how often you adjust these loans, because these are adjustable rate loans. So if you use 30-day LIBOR as your index, then you're going to be adjusting that interest rate monthly. If you use 90-day LIBOR, which is what we want to do, you're going to be adjusting it quarterly, because we just don't want the brain damage of doing monthly interest adjustments.
Yeah.
So that second year you pay interest only, on that whatever your principal balance was at the end of year 1, beginning of year 2, and then in year 3, they're going to make one payment at the end of the year for 15% of the outstanding principal balance, plus whatever interest is owed on that, and because the balance isn't going to be declining if they elect for the annual curtailment. And that becomes, again, a pretty simple calculation. You calculate the interest based on that principal amount. Here's the principal pay down. Here's your interest. Here's the total. At the end of year 3, you'll have to pay. Then you'll do the same thing for year 4. It's another 15% curtailment of the principal plus the interest. And then the final year is basically they're going to be paying off that remaining 70% of the principal plus interest. Now, we figure most businesses will not find that last year's payment schedule attractive, and the hope is that, of course, that all these businesses are, we're past the pandemic, things are returning to normal, the businesses are cash flowing at a stronger rate, so therefore they'll be able to refinance under conventional terms, or maybe at the very least SBA refinance, to then obviously get a longer term and amortization to take that 70% curtailment and make it into a more manageable monthly debt service payment.
That makes sense. And how long does it take to go through the process of getting, is it just normal from the rest of the programs, 45, 60 days, or?
Great question. So, these businesses that we're working with right now have probably been working with us for several months at this point. And part of the reason it's taken so long, we didn't, when the program was first rolled out, there was a huge learning curve for us and for them. And the program, just like the PPP and others, has evolved. There's been, various webinars on this, and lots of questions have been sent into them, and they've revised the FAQs many times. So, sometimes we had eligibility questions that really slowed down the process. Like, hey, is this borrower even eligible? We can't figure it out. Other times we had challenges associated with figuring out the whole, like, okay, they want to refinance debt, but not all their debt, because they're, either they have commercial real estate debt that doesn't make sense to refinance into a 5-year facility because, they got a 20-year term on a 3-year-old note. Why would we want to, yes, they might get debt service relief by putting that into the Mainstreet, but boy, that's going to be really hard to handle when maturity rolls around. And so that kind of thing is discouraged. I mean, the program is designed to be for short-term working capital, or I guess you would describe it as short to medium-term working capital. It's really not for like refinancing commercial real estate. Now, it could be if you're in the last few years of a loan, or if you already have a loan that's on a super aggressive, schedule and was meant to be refinanced, then you could make an argument to the Fed that why this makes sense. But by and large, the Fed doesn't want to see commercial real estate debt being refinanced into this program, because that's not the purpose of this program. So if you have commercial real estate debt, you need to understand, what are the terms of that? What's their debt service? You have to be able to look at, like, collateral coverage ratios in some situations, again, depending on what kind of debt you're refinancing, what kind of debt you're not. And then there's this whole issue about the Mainstreet loans cannot be subordinated. They cannot be junior to any other debt. So again, understanding the terms of their existing credit facilities, and, are there any prohibitions on that? Because if you take out a Mainstreet loan, you can only make payments on other existing debt that are current and due. You can't make any accelerated payments. You can't make any extra payments, or you can't pay it off. None of that until you paid off the Mainstreet loan. So it's been a slow burn to get through all these questions and eligibility and figuring out if these businesses could do it. Then we had to work with our law firm, because with the complexity of this program, we weren't going to try to do these loans in Laser Pro.
Yeah.
So we're doing all attorney prepared documents, and so we had our attorney help us with the term sheets, which took a while. And they'll be doing all the loan documents for us. So it's just been a very involved process, Dave. And I would say that, now that we're earnestly working with a few of these borrowers, we anticipate it's probably going to be, 45 to 60 day, probably minimum, because what we don't know is we don't know how long the Fed is going to take. Now, it says that the Fed is going to move pretty quickly on these when they're submitted, and, turnaround time is likely going to be less than a week. But that's just what we've been told.
Yeah.
And, don't really know until we sort of get our first one through. But, because we're applying our normal underwriting criteria, and then we have all this other, eligibility and procedural and covenant and requirement stuff from the Fed, it's just a lot more complex, and there's a lot more I's to dot and T's to cross. So, we're telling everybody, it's going to take a while, and this is going to go longer than a regular loan for sure.
That's great. That's really good stuff. Do you guys have any questions for Patrick at all that he's not answered on the Mainstreet program?
Patrick, is there any indication how long this program is going to be available for? Is there like a set date for it to be revisited, or an end date?
Yeah, great question, Tom. So right now, and pretty much I think when the program first came out, they said September 30, and then quickly they changed that. Like within probably less than a month, they bumped it to December 31. That's where it remains today. Anybody's guess as to whether that's going to change again? I mean, if I was a betting man, I would say I bet they're going to extend it again, because, let's face it. First of all, the pandemic's not, we can't see the end of the pandemic yet. Secondly, I think that there's not very many loans that have been approved, and there's still a ton of money available, and they're going to have to, again, the whole purpose of the program was to lend this money out. So if you're just going to end it on December 31st and you've only lent out 100 billion of 600 billion, that's probably not going to fly with the general public. So my guess is it's going to get extended, but today the deadline's December 31.
Okay, thanks.
You bet.
Any questions from you, Austin or Dan, for Patrick at all? Celtics?
Pat,
Right.
Patrick, other question. Is there any sort of review or guideline as to what the funds are used for, or any sort of like double check as to how the funds are used once they're in the borrower's hands?
Yeah, that's a great question, Tom. So, again, we're supposed to adhere to our normal underwriting standards. So, a lot of the same sort of monitoring or covenants that you would put on any type of credit facility, again, depending on the sources and uses, is it's obviously up to the bank. Now, the Fed has established some covenants in their documentation, and while I don't know all those off the top of my head, you can go to the term sheets on the Boston Federal Reserve Bank website and pull those down, and it has the covenants in there that they want to be monitored. Of course, it's minimal stuff, but we'll probably go above and beyond that. But they do stipulate that, for example, one of the prohibited uses of funds for the Mainstreet program is growth. So, if you want to, like, for example, I'll use the RV guy as an example because he suffered, but he's back to doing, well. And while he'll show an annual deficit monthly right now, he's killing it. And so one of the things that he said early on was, he's like, I need to buy more trailers. So, I told him, hey, well, I totally get that. That makes a lot of sense. You can't use the proceeds for that. You can't grow your business. This is supposed to make sure that you have working capital to weather the rest of the pandemic and make it out, successfully. So, as you guys are probably familiar with, your underwriting needs to be a certain way, and you have to stipulate certain things and say things a certain way. But like I told this guy, if you want to use the proceeds to, make sure you have enough working capital and you keep that in reserve and you pay some of your expenses with that, normal operating expenses, whatever, that's fine. And then if you're profitable and you generate excess cash flow and you want to take that excess cash flow and go buy other trailers, that's fine. So it's just about how you approach it. It's about how you underwrite it. And it's about, educating your borrower and making sure that they understand what they can do and what they can't do, with the loan proceeds. Now, another thing they can't do, you can't go out and buy a competitor. Again, that's like, seen as essentially
My
broke.
business would be easier if I didn't have a competitor. Yeah, that makes sense.
No, my competitor's struggling and I got a Mainstreet loan and they didn't. I'm going to buy them at, pennies on the dollar, right? Well, no,
Yeah.
you can't do that. So those kinds of, and again, that's just two that come to mind, but there's other prohibitions in the Mainstreet guidance. But essentially, if you want to boil it down, what they want businesses to do is to use this money to cover operating expenses and weather the pandemic. It's not supposed to grow. It's not supposed to make strategic initiatives. Now, we've had a few that were on the fence, like a guy saying that he wanted to buy software that was going to help him essentially automate and expand his capabilities associated with inventory control and supply chain management and stuff that was going to allow his business to be, leaner and more profitable, reduce his overall operating expenses by doing that. So that was a valid, sort of idea and request. And so we could underwrite that. But, just saying that you want to, go buy a whole bunch of stuff and grow, and that's not going to pass muster with the Fed. They're going to reject it.
That makes total sense.
Okay, yeah, that does make sense. Thank you.
Yep.
Well, Patrick, this has been really helpful. And so we really appreciate you taking the time and sharing this about the Mainstreet program. And would you mind circulating to us any material or anything that we could have on the Mainstreet program?
You bet. Yeah, I'll send you guys the link to the Boston Federal Reserve website. There's a ton of information and data there.
Right.
And, everything we've talked about today, guys, is essentially on the for-profit side of the house. There's also a non-for-profit side of the Mainstreet program. They didn't roll that out at the same time. They rolled that out later. And I actually have a request right now that we think is going to be a go on the not-for-profit side. Now, again, we're not a bank that does a lot of not-for-profit lending, but again, for this program with a 95% guarantee, and it's a long-standing Tucson, Arizona not-for-profit, and and they have real estate to pledge, which is like, a little bit, outside the norm, I would say, for not-for-profits. Not all of them, but, it's just, a lot of not-for-profits don't have a lot of physical assets. But this organization over the years has invested in property that they use for their locations and stuff. So they have ideal collateral, really. And so we're probably going to be able to move forward with them. So I just throw that out there to let you guys know that it's not just for-profit businesses, it's not for profits. Now, again, the SBA, because the Fed is following SBA guidelines, there's some pretty stringent regulations on which non-for-profits qualify. And it's essentially like 501c3s, tribal, and I think like 501c19s or something. There's only like 3 types of nonprofits that qualify. So like clubs, like C6s don't qualify. There's other ones that have approached us, C4s or C7s. They don't qualify, unfortunately. But your more traditional not-for-profit 501c3s, they definitely do. But again, there's still criteria they have to meet. Like if they lost money last year, and there's also, I'm becoming more of an expert on this, as the days go by. But non-for-profits get their money both from donations and also other types of revenue-generating activities. And there's a threshold in there that they have to have, like at least like 50 or 60% of their revenue comes from non-charitable donations. So they have to be doing something to generate revenue. They can't just be begging people, essentially begging people for donations and money and qualify for this program. It won't fly. So anyway, I just wanted to mention that, get that out there. And I'll send you guys, that link to the Boston Federal Reserve website. I might have a couple of other good documents to send you guys, but really our source of information continues to be the Federal Reserve website and the FAQs that they continue to update. We do participate in webinars whenever they're offered. I think there's another one on Wednesday of this week. And there may even be a way for you guys, even though you're not an eligible lender, there may be a way for you to participate in those webinars and sign up for them if you wanted to. Because they've had some good success stories on there, like people that have gotten, Mainstreet loans done, and they kind of talk through it as a case study. They've also had, just good feedback from various players at the Fed and the SBA that, sort of helping the Fed with eligibility and stuff, talk about, questions and how they've made clarifications and changes to the criteria. So it's been useful.
Patrick, thank you so much for your time, and we will definitely be giving you a call here soon.
Okay, no problem, guys. And hey, just for let you know, for our bank, so this goes back to how every bank's a little bit different. Commerce, again, this is a lot of people that we've turned away. I've had people, Dave, from New York, LA, San Francisco, Boston, you name it, Bismarck, North Dakota. I've had people reach out to me from all over that want to take part in this program. And they would probably qualify. They probably hit every wicket except for our bank only works with Arizona small businesses, or if a business, might operate in multiple states but has a substantial tie to the state of Arizona, whether it's the ownership or whether it's the operation. So we're only taking Mainstreet loans for businesses that are either located here, whether it's HQ or whether it's they have a location here, they have to have collateral here, they have to have some, ties to the state, or our bank is not doing it. And that's more related to our state charter, our agreement with our regulator, that, we're not going to get outside of our box as a local community bank. So I just want you guys to be aware of that before you come to me with a California deal or a Nevada deal or something like that. We're doing one right now with a business that has an Arizona location and a Nevada location. That's okay, because they got the Arizona location and they have some property here, and we can do that. But if there's no ties to the state, we're not going to do it.
Okay. Well, that's terrific. We will be in touch with you, my friend. And again, thank you so much.
You're welcome, guys. Anytime.
Thanks, Patrick. Appreciate it.
You bet.
Take care.